Hello guys, welcome back to the full course of institutional supply and demand trading course. Okay, now we're back to where we left off, and last time in the other video we were talking about trading view, and we're still in trading view. We talk a little bit about time frames. We talk a little bit about the tools over here on this side. We talk a little bit about the different types of charts, and we said we really all the time we just use the candlesticks, okay, Japanese candlesticks. Now we said we're gonna dive deeper today into the anatomy of a candlestick, because it's really important that you learn to read these candlesticks. Now, as you see on this left bar, we have price. Okay, that's the price, and price is gonna fluctuate, you know, throughout the time frame that you have selected over here. So we said one candlestick, for example, right now we have selected the 4 hour. One candlestick, it's 4 hours in time. Okay, if we go to 2 hours, one candlestick now is 2 hours in time. If we go to 1 hour, now each candlestick is 1 hour in time. Now we're gonna go into deeper into the anatomy of candlesticks. Now you should start taking notes right now, and we're gonna go through this real quick, because honestly candlesticks are not that hard. Now we already said, for example, if we are in a 4 hour time frame, a candlestick has basically this anatomy. Okay, so the highest point during that time frame that the candlestick went to, that is called the high. For example, if you have selected the 4 hours time frame, that will be the height of the 4 hours. If you have the daily, that will be the height of the daily. Okay, and then the low of the candlestick, it'll be the bottom of the wick, and that'll be same thing. If it is a 4 hour, the low of the 4 hours. If it's a daily candlestick, it'll be the low of the day. Okay, now the candlestick is made of the body and then the wicks. We already talked about the wick. The wick, the height of the wick is the height, and then the low. Now the body, the way we read the body is, for example, on a bullish candle. Now those term bullish, it means when you have a green candle when the market is going up. What this means is over here at the bottom of the body, that's what we call the open. Now the top of the body, that's what we call the close. Why? Because what this means is that, let's say we had the 1 hour selected and it's 12 o'clock p.m. Okay, so at 12 o'clock price, this candle opened over here, and what this candle is telling us is that during that 1 hour between 12 and 1 p.m. price at some point came down here, and then buyers came into the market and pushed the price all the way here, and then at the end, when the clock marked 1 p.m. market was over here, and that's when it closed. And then automatically when this candle closed, now we have a red candle, which is a bearish candle. That means the price went down. And if a green candle, the open is at the bottom, and the bearish candle, the open is at the top, because it went down in price. So the high and the low stayed the same. The top wick is the high, the bottom wick is the low. And what this means is, if we say that this was 12 p.m. when it opened, price came down here at some point during that hour, went up there at some point in that hour, and then came down here. And when it was 1 o'clock p.m., price was here, this candle closed, automatically the next candle closed. Then the same thing happened over here. At some point price kept going up, but then sellers came into the market and pushed this market all the way down. And by 2 o'clock the market was over here, and that's where this candle was fully printed. And now we have this other candle, bearish candle, and we know that this bearish candle it's a bearish candle because it opened up here and it closed down here. And on the green candle, it was the opposite. It opened at the bottom and it closed at the top. And then, you know, the colors are the ones that are going to tell us it's a bullish candle or is it a bearish candle. In this case, automatically when we see the red color, we know the open is at the top, the close is at the bottom. When we see the green candle, opens at the bottom, closes at the top. Now we have a few, we're just going to go through the few most common candlesticks, because the way that we trade, we don't trade candlestick patterns, we don't trade candlesticks, we trade fully structure and supply and demand, and supply blocks and demand blocks, and we follow institutional order flow to place trades, and we use time frames and structure to take our trades. So we don't really use candlesticks, but we're going to go through just the most common, so that way you have an understanding of candlesticks, right? And it's easier for you to read the chart. Now in this case, this is what we call a bullish engulfer. Okay, a bullish engulfer is when you have the market that is coming down, okay, and then you have a green candle that it's a bullish and fully engulfs the last red candle. In this case, like you can see this big body, really small wicks compared to the body, and completely like runs over the last red candle. Now I don't have a bullish a bearish engulfing in this example, but it's the opposite. Let's say, for example, you'll have these 3 green candles, and then at the end of it here, for example, let's say there was let's say over here there was a big candle, red candle, right, that completely engulfs the last green candle, and now that will be bearish engulfing, okay, candle. Now hammer candles are usually bullish. Usually this will mean there's a lot of buying pressure. Why? Because it doesn't matter that the body is really small. So for example, in the green candle, that means the price opened over here. At some point during the 1 hour, if we keep the time frame in 1 hour, price was all the way down here, and then buyers came into the market and run over all the sellers that were in the market, and price closed above the open. So there was a big momentum during the 1 hour that pushed the market all the way up. Now same thing on this one, okay, it's just a little bit weaker than this one, but it still shows a lot of buying pressure. Okay, so since it's a red candle, we know the opening price was up here, then during the 1 hour price was all the way down here. At some point this was a big red candle, but then buyers came into the market and pushed the price all the way up here, and it closed here. Okay, and this will be a hammer candle. Okay, the opposite to that is a shooting star candle. Now the shooting star candle, it works just the same as the hammer. So we have no bullish shooting star. A shooting star, it's a bearish signal, no matter if it's a green or a red candle, like in this case, because it's the opposite. The same psychology applies to this as bullish hammer. Okay, so what is happening here is at some point this was a huge green candle, and then sellers came into the market and pushed it all the way down here, and it closed here. Now same thing with the red candle. You know, we know because it's red, the open, it's basically right here, right? And then at some point this was a big green candle, but then sellers came into the market and pushed it all the way down here, and then it closed over here. Okay, that's why there's a lot of selling pressure. Okay, then after that we have what are called dojis. Now dojis are indecision candles. Like this, whenever we get a candle, you know, a doji candle printed, we just wait. We just stay on the sidelines of the market. Well, retail, you know, stays on the side of the market. I don't trade candlesticks, because even within this big candle, there's a lot of structure. This doji, there's a lot of structure inside this candle on the lower time frame. Okay, so we're gonna learn that in the future. But it's good for you to understand that this is a dodgy candle. Okay, and then on this candle, what it means is this one is a green candle, so it opened over here at the bottom, right? And then at some point during an hour went all the way up here, went all the way down here, and then closed over here almost at the same spot. Okay, same thing with the red candle. You know, it opened over, because it's a red candle, we know it opened at the top. At some point price just went, you know, it was just in this range, and then it closed almost at the same spot that it opened. Okay, it doesn't matter how big the wick is. Okay, if the close and the open are really close and there's almost no body, that is a dodgy candle, and it's going to be taken as an indecision. So those are the 4 main candles. Now we're going to try to go and spot them in trading view. Okay, so if we come here and we go into, maybe let's go to the daily candle, and we'll see. So just a really quick review from what we were learning right now. So we know if it's a green candle, that means the opening is at the bottom. So if we take this candle right here, right, we automatically know that it opened over here. Okay, so in this day at 2 p.m. when the market opened, it opened right here. Okay, then during the day it came down a little bit, but then it went all the way up and it came up here, and at 2 p.m. the next day the market was over here. Okay, and it closed right there, and automatically when it closed right here, you know, the next candle started printing, so it opened right here, and now we know this is the open and this is the close because it's a red candle. So we know this was the open. At some point during that day, this was a small green candle, but then sellers came into the market and pushed it all the way down here, right? And it was, at some point, it was a big bearish engulfer all the way here, but then it came back up here and then it closed here, and now, you know, that was the close of the day. And then this dodgy, it's a dodgy, and what they would say before, that it's you know, it doesn't matter how big the wicks are, if the body is really small, that means it's an indecision candle. And now right now the markets are closed, so this was basically the last day on Friday, so that means this was just a big range that was going on. Okay, but you know, the same applies. So this is a green candle, so that means the open was at the bottom and the close was at the top, and at some point this was a big, you know, green candle, and you know, at some point it was a big red candle. Okay, and then at the end of the day, you know, it came back up and then it closed over here. So now we're gonna have a you know, 2 examples right here. Now here is a shooting star. Okay, this is supposed to be a what? A bearish signal, right? But because it's right here in the middle of this range, you know, we don't know. So we have to learn to use those. Here's another shooting star, right? We got to use the structure. So we know we have structure here, you know, it's a higher high, higher low, then, you know, it starts to break structure on the lower time frames, and it's just getting this pullback, and then you get printed this big shooting star candle over here, right? If you were to be trading candles and you have a structure that is bearish and you get this bearish signal over here, then you would have maybe, you know, taken at the close of this candle, you know, taking this trade, right? You put it over here just above the wick to protect yourself, and maybe you would have gone for a 1 to 2, and in this case that would have been a winning trade, right? And that's how basically you start trading the retail way. But we are not gonna trade that way. I just don't trade retail. I know the concepts because I started in retail, but then I was losing for so long until I got introduced to the system that I'm trading right now, which is, you know, institutional demand and supply and smart money concepts, and everything changed for me. Okay, so if we go to the let's see if we can find another. Here's another. You can take this as a hammer, because it has a short wick to the top, small body, and a big wick to the bottom, right? And then it goes up shortly, and then you get another shooting star printed at the top, and then you keep going down, and then another shooting star over here. You got a big shooting star over here. You have a bullish engulfer over here, and you have another bullish engulfer over here. You have one pull down, right? This red candle, and you have this big candle that just engulfs that candle, the red candle, right? And the market continues, to the top side. So I mean, if you really want to learn a lot about candlesticks, just go to Google and just type candlesticks, Japanese candlesticks, and go to the images, and you're gonna find like so much content on candlesticks. Okay, I won't recommend to go deep on that because we're not gonna be using that for this course, but it's always good to know. Okay, now that we know what candlesticks are, I think on the next video what we're going to do is we're going to start we're going to open a paper trading account on TradingView, and we're going to take a look at a few brokers, and we also going to talk a little bit about pips and spreads and orders. Okay, so we can actually start kind of like playing around with a demo account, a really quick paper trading account or a demo account. It's just you get an account with fake money in it, but you're trading the real markets, like you trade in the live markets, but you have, for example, you can get like $100,000 account on TradingView, but it's fake money, it's not real money, but you're placing trades as if it was real money, and everything gets treated as if it's real money. So usually the goal before you start trading your money is that you have to at least flip 2 paper trading accounts, like take $100,000 paper trading account, turn it into $200,000, and then turn it into $400,000. If you can do that on your paper trading account, then you'll be ready to take your real money and trade it. Now, I'm not a big fan of that. I rather think like start trading with paper trading while you are learning how to place the orders, learning how the spread affects you in the time frame that you're trading. But once you're comfortable and you understand the system, how to place trades, how to close your trades, then and you understand a little bit of you starting to develop your own strategy and your own edge, then I would recommend to open an account with a broker with let's say $100. Okay, the minimum $100, and then just treat that account as if it was the $100,000 account. Okay, don't try to flip it. Just risk the same 1% on that account, and just treat like every dollar as if it was $100,000. But now, because it's real money, that if you lose those $100, it's real money. Like, it's gonna start affecting your psychology, and then from your psychology, you're gonna start seeing your weaknesses and your strong points. Okay, because trading is about 20 to 30% technical and 70 to 80% mental. Okay, psychological. Like, you have to be psychological strong to handle losses and to handle all the pressure that you get when you're placing the trade, because you don't know the outcome. Okay, so for now, we're gonna dive deep into psychology later on in the course, and as I get more open and it gets easier for me to talk on the mic, because right now I never really teach anybody, so I know I stutter a lot, so thank you for bearing with me, but I know I will get better as we go on with the videos. So for now, we're just gonna stop the video right here. You got an introduction to candlesticks. You kind of know where everything is on TradingView, and on the next video we're gonna open a paper trade account on TradingView, and then we're gonna start placing trades and playing around with real money. Okay, so I mean, not real money like the fake money, but like real trades. We're gonna place trades, so that way we can explain what a limit order is, what a buy order is, a stop order is, what a market order is. We're gonna talk a little bit about spreads, and so on and so on. Now, once we get, I think, into around video number 5 or 6, the first video that we do about structure, market structure, that's when everything's gonna start getting really juicy, and you won't regret it. There's gonna be something that you can learn from there, whether you're a beginner, whether you're like intermediate, or you're really advanced in your trading. Okay, but you're still struggling to be profitable. So I'll see you guys in the next video, and I hope you guys have fun and keep playing with TradingView. Try to read the charts, try to understand the candlesticks, but we do not trade candlesticks in this course. Just be mindful of that. All right, so see you guys in the next video. Peace.